Let's talk about tax-free money in retirement. In the United States, there's really only one thing in our tax code that's truly tax-free. Before we start to get into the details, we must first understand the federal tax rates. And if you look at the top marginal bracket here, it's low. So you can take a look at and see where it's spiked, how high it's been. It's been as high as 90%, where they're taking 90% of every dollar that's being earned. And it's relatively low today, but you also have to be mindful. You should take a look at the lower brackets. Depending on where you are will be important. So looking at both the top marginal bracket and the lower bracket. So why is this important to even understand? Well, when you put money away for retirement, traditionally, you're putting it into a pre-tax asset, and we'll get into the differences and where you can invest money, but you're putting it into something so that when you're taking that money out, it's getting impacted by this federal tax rate. So these rates are important to understand, keep in perspective while we go through this together to discover real, true tax-free money in retirement. What is the list of things that you can actually invest in that will create tax-free money in retirement? So here's the list. The first thing, health savings account. The second thing, they're muni bonds. Again, people invest in them to get that federal tax-free money. The next thing are Roths, right? Roth IRA, Roth 401k, and the last one is life insurance. All of these roads will lead to these four categories when you're looking at tax-free money in retirement. So we're going to break this down. Health savings account. If you are able to have a health savings account, great. Typically, they're by an employer. Set it up, take your paycheck, put money in that's not taxed, and then basically that money can be used later on tax-free. That's a no-brainer. The next are muni bonds. The money is federally tax-free. Low yield, but remember something. When you do something like a muni bond, you have to pay the tax and put the money in. So it's post-tax. Next are Roths. Roths are very interesting because if you can contribute to a Roth IRA, typically the contributions are relatively low. That's one of the knocks on the Roth IRAs. But once you pay that tax and the money goes in, it grows tax-free and you can access it tax-free. Also, when you have IRAs, you could potentially convert them to a Roth. Now, again, that's something that's going to be causing a tax now, pay later, right? So you're going to be taking that IRA that was not taxed and converting that to something like maybe a Roth. The last thing, which is a little misleading for a lot of people, but it causes a lot of interest, is life insurance. People say, life insurance, how does that work? Life insurance is an interesting product because when you take money and you put it in and you access it, what happens is you're actually accessing it via a loan. You're borrowing from the insurance company, not borrowing from yourself. You're borrowing from an insurance company, and because you're borrowing it, it's considered tax-free. When you put money into a life insurance product, you can fund it, again, after tax money going in, and that money now will grow inside of the actual product, so you're not getting taxed on the growth, and then you can access it. Also, one thing to just keep yourself aware of, you have to be able to understand that yes, the money that's inside of it is growing, the money inside of it you can access, but it's not tax-free income. Remember that, because you're borrowing it. It's tax-free, maybe cash flow, but it's definitely not income. And also, you have to be comfortable with the fact that there's a debt. So it's something that you're borrowing against, and there's a debt that's inside of it. So again, there's a tax play here, but you psychologically have to be okay with the fact that this is something that is going to be a debt obligation that necessarily you don't have to pay back, but it's still a debt. And a lot of times people will send me things, send me a flyer, a mailer, a text message, a link all the time. And so someone was nice enough to send me this. So I'm going to just give you some examples to give you just some idea about how this all works. So this one is a program that you can attend, and it says potentially avoid double taxation on your IRS targeted retirement accounts. Ooh, IRS targeted. Well, yeah, that's because you put money into an IRA or a 401k. Double taxation, again, what are you doing with this money? You're going to take it, you're going to do a Roth conversion, you have to pay the tax. There's no way to avoid double unless you do these things. Or take it, pay the tax again, and maybe put it into a life insurance policy. That's it. Legally bypass capital gains taxes. So again, you're not paying tax on growth. Where do you put the money to not being taxed on growth? Roths, life insurance. Here's one. Reduce and even help eliminate income taxes on your IRA and 401k. You guessed it. Convert to a Roth or put it into a life insurance policy. And then here, I love the word potentially. This is potentially convert unused assets into a tax-free income you can outlive. That's definitely a little bit misleading, because when you start creating tax-free income you can't outlive, you got to really be looking into various annuity products, because otherwise you can outlive it, and tax-free is just a matter of converting it. So that's one example. Another one, people publish very, very popular books. Sometimes they call these books a fund. I'm not going to even get into specifics because I don't want to promote the book. Calling something a fund when really the fact of the matter is it's a life insurance policy. In this particular example, the subtitle says how to diversify and create the foundation for a tax-free retirement. And again, tax-free in the United States is pay tax now, pay tax later. You're either going to convert something to a Roth, right? Or convert something where you pay that tax and put it into something else. People online will say things like tax-free income using strategies, tax-free income. So there are no tax-free income using strategies. You're either going to do a Roth conversion, and that will be tax-free. If you are looking at tax-free cash flow, that's from a life insurance policy. So you can't use the word income, because income in the United States, you pay tax on income, okay, unless it's a muni. So when you have something where you're putting money into a product and you're accessing it via a loan, it's not technically income. That's why you're not paying tax on it, because the money's being borrowed. And also, getting text messages from a very good client of mine. Here's the title of this: Strategies to Slash Your Taxes in Retirement. And they buy these URLs, the Institute of, and I'm not going to again promote it, but complaints savers have about their 401ks. You owe taxes on compounding growth. Yes, you're putting money in pre-tax. The whole idea is to have it grow and compound. Next, here, another complaint they say is you take all the risk because neither the growth or the principal is guaranteed. Yes, it's because it's an investment. It's in the market. That's not guaranteed. And then the last little complaint is your savers are virtually trapped until you decide to retire, and accessing the money sooner than 59 and a half can be penalized up to 10%. Well, that is partially true. Yeah, you could take a 401k, roll it into an IRA, and do a 72T distribution to avoid that 10% tax penalty. And then you have complaints savers have about their Roth IRAs. So people love their Roths because you'll pay taxes now, but you get both your contributions and gains tax-free, right? Which is fantastic. And then they have the buts. Oh, but you're limited to how much you can put in, which is true. You can't put a lot in. Next one is you take the risk of getting caught in volatile markets. Again, it's in the markets. I think we all know that. Your savings is virtually trapped again, that trapped word again. And this is all about retirement planning. So we're putting money away for what? The future. And then they talk about the potential benefits of strategies that you won't have to pay taxes on your gains. Again, it's inside of either a Roth or a life insurance policy. So you have to like that. All roads will lead to these products. You'll decide how much you want to save, not the IRS. Again, if you're going to start to fund something, whether you're saving into a 401k or saving into a Roth or saving into an insurance policy, you're the ones controlling that. You won't have to report the income to the IRS, quote, income. Now that's, again, it's not income, okay? It's cash flow because you're borrowing it, and then you'll sleep well because some of the strategies come with guarantees. I would definitely stay away from that. So I wanted to kind of just share with you some of the things that people share with me on a consistent and ongoing basis about tax-free money in retirement. Before we close, I just want to bring something to your attention. There's a great channel, Retirement Transformed, Markham and Judy Rollins. They have a great channel on retirement planning. It covers everything about retirement but finances. So I recommend to check them out, and hopefully we'll have them on our channel at one point or another. I'm Harry, with you every step of the way.